Good afternoon, ladies and gentlemen. It is my great pleasure to welcome all of you to this fourth Andrew Crockett Memorial Lecture. I would say that all of us in this room have extremely fond memories of Andrew. He made huge contributions to central banking. He made also great contributions to incorporating in our day-to-day activities serious considerations about financial stability. He was a very distinguished general manager of this institution, among many other distinguished activities. And this lecture series is our way for the BIS and the BIS community to honor him. In this case, we have, as in the past, a brilliant lecturer. This year it will be Amit Seru, who is the Stephen and Roberta Denning Professor of Finance at the Stanford Graduate School of Business. He's also a senior fellow at the Hoover Institution and a research associate at the MBR. Amit was also a member of the faculty at the University of Chicago's Booth School of Business, and his papers have appeared in all the distinguished journals, in particular the American Economic Review, the Quarterly Journal of Economics, and the Review of Financial Studies. Amit's research centers on financial intermediation and regulation, as well as corporate finance. We really look forward to his lecture, which is on regulating banks in the era of fintech shadow banks, a topic of really importance and that we all, I'm sure, will get a lot out of it. Amit's lecture will be followed by a panel discussion of governors, chaired by our chairman, Jens Weidmann. And after the panel, we will have a Q&A session with the audience. At given stage, you will have the opportunity to ask questions to Amit and also to the governors. All parts of this lecture, including the panel and Q&A session, will be recorded, and the video will be available on the BIS website tomorrow. So without further ado, I hand the floor to Amit Seru. Please, Amit.
All right, thank you very much for this honor. It's a pleasure to give this lecture here, and I'm going to be talking about the changes in the landscape of lending that have been pretty dramatic in the last decade and a half. In particular, I'm going to be talking about the entry of shadow banks and fintech shadow banks and how they have altered the landscape of lending, not just in the US, but globally. And I will talk about what the reasons for this rise of shadow banks can be boiled down to. And I'll argue that regulatory pressure on banks and technological progress seem like two prime candidates for why shadow banks have increased in their presence as much as they have. Then I'm going to spend a lot of time talking about how we should think about regulation in an era where a large part of the market is now shadow banking. And here I want to sort of emphasize that if we ignore shadow banks when we think about policies such as financial stability, what we might end up having is a huge gap, a huge wedge between expected policy responses and actual policy responses. And I will argue that if we want to sort of do policy now, there are three pieces at least that we need to focus on. One is what I call understanding the business model of banks and shadow banks. The second piece is understanding the industrial organization of how these different entities are competing with each other. And the last is what the equilibrium interaction between these entities is, because these feed in directly into our expectation of what the policy response might be. So that's where I'm headed, and let's sort of get in there. So the first thing I want to sort of illustrate here is what has happened in the landscape of lending. And I'll give you a few examples from the US, but you can think about the context more globally as I will touch upon some of these patterns outside the US as well. So what I have here is in the US personal loan market, which is around $1 trillion loan market, from 2007 till 2017, what has happened in terms of shares of new originations. And you can see that shadow banks have slowly but surely gained a lot of market share. What is unclear here, but I'm telling you is a fact, is that most of these shadow banks are fintech shadow banks, which means they rely a lot on technology to do their lending. Now, if this isn't dramatic enough for you, going from around 35% to 55%, perhaps the largest sort of increase that one has seen in the US is in the largest credit market, consumer credit market in the US, which is the mortgage market. And here we have longer time series from Credit Bureau, and what you can see is that the shadow bank share was around 30-35%, but after the great financial crisis, what you see is that shadow bank share has dramatically increased, and now pretty much 2/3 of the market is shadow banks. So that's pretty huge. And it's not just these two markets, but more generally, what you sort of see is that these shadow banks tend to be fintech shadow banks. So here is, if you just looked within the US and asked the question, who is it that is doing a lot of this lending? The red bars here represent fintech shadow banks. And the largest lender right now is Quicken Loans, which has this product known as Rocket Mortgage. I'll talk about it when I talk about technology. And what you can see is that the traditional banks like Wells Fargo, JP Morgan, Bank of America, they are in there. But if you look at the lending, a bulk of it is getting done by fintech lenders right now. This is not just these two markets. Here is a few other markets. If you look at small business loans, again, there is a lot of fintech shadow bank entry here, lenders like OnDeck and Cabbage. If you look at student loan market, which is a pretty big market in the US, a $1 trillion market as well, pretty much the largest lender here are all shadow banks and fintech shadow banks like SoFi and so on. So this is something that's happening across the board, not just in consumer credit, by the way. You can look at also corporate loans. And when you look at the corporate loan market, this is a picture done in a paper that was presented in a BIS conference last year, where the researchers looked at the leveraged loans in the corporate market. And what you see here is plotted as the shadow bank share. And the different bars here represent the composition, which entity is really financing this. But the moot point here is that if you look at the trend, it's pretty clear it's going up over time, and dramatically so. Now, this is not just US. If you look at the Eurozone, we know that shadow banking in Eurozone, now there has been enough number of studies which talk about how there has been a progressive increase in shadow banking in Europe over the same time period. What is not clear here, even though, again, there are different entities talking about which are doing shadow banking, what is not clear here is this lending or is this investments. All of that is conflated here, but there are enough papers out there and research out there which suggests that a lot of lending in Europe is also now happening increasingly in the hands of shadow banks. So that's Europe. If you look at China, we know the story there as well. There is a lot of shadow banking. Now, shadow banking in part in China is intermediated through banks, so it's not entirely outside the banking system. But then there is the retail consumer side with Alibaba and Tencent, where a lot of this lending is happening outside in ways that are pretty large and sort of get to the point that I'm trying to sort of get at. Now, why is it that shadow banking has grown so much? And the usual candidates, people have different explanations, but the usual candidates boil down to two. One is that banks are facing a lot of regulation, and as a result, they have retreated, and shadow banks have stepped in. So that's one explanation. And the second is we have had huge amount of technological progress. There is big data, there is machine learning, artificial intelligence, and fintech lenders, fintech shadow banks are able to leverage on this way better than banks can. So the question is, are these just anecdotes, or can we actually rigorously see this in the data? And now with the micro data that's available, you can actually rigorously see what is happening on the ground. And I will give a lot of examples from the US where I have a lot of data, but it suffices to say that this is also true outside US, where there is a lot of research which has shown similar patterns. So let me first talk a little bit about regulation. So what do people mean by regulation? That, there was, in the aftermath of the crisis, capital constraints were tightened, supervision was tightened, and as a result, banks essentially retreated. How can we rigorously see this? Again, let's look at the mortgage market. Again, I told you in the US, mortgage market is a $1 trillion market. We can see, because we have very fine data, on where were shadow banks before the regulation started kicking in. And a simple way of sort of doing that is to look at the regional variation. And what I have plotted here is, in different counties, what was the exposure of shadow banks in 2008. And if it's light colored, that means not much. If it is dark colored red, then means a lot. So you can see that there was some exposure, but not a lot. Fast forward this just by 7 years, not much. And what do you see? You see a big change here. And the exposure here has changed dramatically. Lots of reds. Now, one thing which is interesting here is it's not uniform. It's not that shadow banks just have uniformly decided to enter everywhere. So the question is, can we do something about it? And in some research with my collaborators, what we asked was, can we look at variation across regions in shadow bank entry and see what it is related to? And what we were interested in was studying that as banks faced regulations at the regional level, was it the case that banks retreated and shadow banks entered? And indeed, that's what we find, that if at regional level you look at how much regulation, supervision is tighter, banks retreat a lot, and shadow banks and fintech lenders enter a lot in those markets. And if you want to see some evidence, here is that evidence presented in a very simple way. What do I have here? On the x-axis, on the y-axis is the change in shadow bank share. So you should think about going from light to dark. That's what's being plotted on the y-axis in both the pictures. In the x-axis, what I have plotted is what's happening in that region in terms of regulatory costs or regulatory pressure that the banks are facing. On the left picture, we are looking at how much capital they raised during that time period. And on the right picture, what we see is how much of fines did they get imposed because of supervision, which looked at their books more carefully, potentially, after the crisis. And what do you see? You see a monotonic positive relation. As regulatory pressure is more on the x-axis on banks, shadow banks have entered. If I were to show you what banks are doing, it's a mirror image. It's not one for one, but it's a mirror image in the sense that there is a negative relationship there. So areas where regulatory pressure is getting tighter, banks are retreating and shadow banks are entering. All right? So, and this is not something, again, as I said, only in the mortgage market in the US. People have looked at this same idea in corporate loan market, in the leverage loan market. The picture that I showed you before of corporate levered loans. Again, what you find is as banks faced regulation, that's where corporate loans have been taken up by non-banks or shadow banks. Similarly, researchers have looked at this problem in China and sort of concluded that regulation has played a pretty important role. What about technology? Given that a lot of these shadow banks are fintech shadow banks and are relying on technology, what really is going on as far as technology is concerned? When people have technology at the back of their mind, they are thinking, well, technology lowers cost, so that allows us to provide the product maybe cheaply. They also have at the back of their mind that technology allows you to look at data in different ways, big data. You can mine it better. Maybe you can do risk profiling better. Maybe you can offer better quality products. So what is going on? Again, depending on the context, you will find some variation of these three things that I just mentioned. But let me give you an example where probably all of these things are present, and that comes again from the US market with Quicken Loans. So Quicken Loans has this product known as Rocket Mortgage. What is this product? It essentially asks you, shows you a picture like this. It's available, it's an app which is available on your mobile phone or your iPad or your computer. You enter a few details, your name, your address. It already knows, the company knows who you are, okay? Once they know who you are, they can run through all the steps very, very quickly and give you a rate which takes banks a lot of days to sort of arrive at. So they can get, here are like 10 steps, and they can get to 10 steps very, very quickly. Now, how do the Quicken Loans do this? Back in the day, Quicken Loans used to be a part of an entity which was doing taxes in the US. So they have a lot of information that they used before and have experience with, which includes things like W-2s and so on, which banks actually have to ask you, have to collect, while they don't have to necessarily ask you or collect. As long as you say agreed, you can go ahead and do it very quickly. So let me sort of give you some more flavor of what Quicken has done that has made it the largest lender. And that's pretty much the flavor that most of these other fintech lenders are doing in different markets. And in Q&A, we can get on other markets if you're interested. So here is one statistic which is very interesting. Most of this industry spends a lot of money, banks and shadow banks, to try and sort of originate loans. And if you're in the business of selling them, you try to sell them pretty quickly, because otherwise you're bearing the warehouse risk for the time the loan is on your balance sheet. So what have I plotted here? Because Quicken is so fast in getting information and doing other things, what I have plotted here is just a very raw number of time it takes to sell a loan, okay? The dotted line is traditional lender bank, and the solid line is Quicken Loans. And what you can see is it takes 45, 50 days for a traditional lender. Quicken is able to do this 15, 20 days faster. That's a pretty big number, because that amounts to them doing much, much more volume and turnover. What about information? Can we sort of look at information? We absolutely can, because they are so dependent on information about you being in the system somewhere. They have decided to be a dominant player in this market known as the refinancing market. What is a refinancing market? It's not the first time you've gone and bought a home with a mortgage. It's the second time or the third time, because you're refinancing your loan. What's the advantage? The data is out there about you. Credit history is out there. So what do I have here? The red line again is showing you Quicken. 95% of its loan are all refinancings. A traditional bank also does refinancings, but to a significant lower degree. And that again tells you that they are using a ton of information. Is there any specific information that we can boil down to? There are many, but let me show you one which is very interesting. There is a variable which is related to the race of the borrower, because one of the concerns regulators have has to do with discrimination in the consumer credit market. And many times the race is not declared, okay? Now banks tend to be pretty careful, because if the race is not declared, they don't know whether we are discriminating or not discriminating. So they keep their share of loans to scenarios where race is not declared to a pretty constant number. So the dotted line shows you that their share is typically 65% if the race is not declared, okay? What is Quicken doing? Slowly but surely it's figured out that among those borrowers are borrowers who are of good credit and who they can lend to. And you can see the big wedge between Quicken and banks as time has progressed. And let me tell you that as Quicken has entered more and more into this market, the loans have not defaulted at all relative to banks. In fact, they have ended up prepaying a lot. They have somehow figured out ways to identify borrowers which look same to banks and to them, but they have more information which allows them to identify borrowers who prepay quickly. Why is prepay good for them? Because more the prepayment, the more quickly they can get the loans out of their door, the more volume they can do. So they have figured this out using some other information and other data. Now, you might wonder that, is that all they do? It seems they provide a lot of other sort of convenience and quality, even after your documents have been taken, when the product is getting close to closing of the loan and so on. There are surveys done consistently in this market, like this JD Power survey, which rank Quicken loans very, very high when it comes to quality. And if you dig deeper, it's all related to how quickly they are able to get all the information, and it's pretty hassle-free. Now, you might ask that, okay, so there is an element of being efficient, there is some different data, but what are they doing in terms of prices? What happens is that, like, because they are using tremendous amounts of data, they are also able to identify parts of the population who actually value convenience, who actually value speed. How do I sort of know this? Here is a very interesting figure. What I have plotted here is the interest rates that borrowers pay on loans originated through Quicken versus traditional banks. Dotted lines, traditional banks, solid line, Quicken. What do you see? Quicken is charging a premium. So what have they done? They have identified borrowers who are actually willing to pay for convenience. So in other words, they have found most of you guys in here somehow, because you would be willing to pay for convenience. I would imagine your opportunity cost of time is very, very high. That's what they have done, while banks obviously haven't done that. Now, that's essentially what I have to say in terms of what I think are the factors which have led to an increase of shadow banks and fintech shadow banks, not only in the US, but outside. And that brings me to the main part of the lecture, which is that, okay, so going forward, given that shadow banks are huge, they have these two things which might have led to their increase, but they are here now, how should we be thinking about regulation? And I'm going to argue that we need to think about regulation in an integrated way, where shadow banks and banks are considered side by side. And I want to emphasize three elements when I say side by side. One element is that we need to understand their business models. The second element is that not only do we need to understand their business models, but we need to understand how they're competing, because they compete on price and non-price dimensions in ways that are pretty subtle. And you'll see what I have in mind. And then the third element is that we need to emphasize thinking about equilibrium interactions between them, because if you want to do policy, you want to sort of think about how the equilibrium interaction between them is going to change when you're going to move a policy lever. So let me talk about the business model first. When you think about banks, what do we think banks do? Well, banks, they take deposits, they make loans, they might sell some loans, but they might keep some loans on the balance sheet because they have a balance sheet capacity. That's exactly what you see in the data. So let me again give you an example from mortgages, just because again we have micro data. So what is this? This is traditional banks. What are they doing over time? There are different entities here depending on where the loan ends up once the traditional bank makes the loan. But let's suffice to focus attention on the middle two pieces. So the middle piece is it's sold to an investor. The largest investor in the mortgage market, for those who don't know about the US mortgage market, is the government. They are called the GSEs. But think about this as they sell some of their loans, and then they retain a bunch of loans also on the balance sheet, about 30, 40, 50% over time. So, which is pretty reasonable. Now, do all banks retain the loans on the balance sheet? Turns out no. It depends on your financial condition. So if you look at financial health of the bank and ask how much do you retain, that's what I have plotted here. On the left, I have in the x-axis on both pictures, left and right, capital ratio. So as we go from left to right, capital ratio improves. And then on the y-axis, I have how many loans are you retaining on your books. And what this is, both these pictures are trying to tell you is that as my capital situation is better, I can retain better. Which is, you can say that, yeah, that seems reasonable, but it's good to sort of see. And the left picture sees this in the cross-section, just comparing across banks in the economy. And the right picture says, okay, let me just look within the same bank. So if I look at just Citibank, and Citibank is in a good position in terms of capital, and in a bad position in terms of capital, does Citi hold more or less? And that's what the right picture is saying, that this is true in general. So banks, business model, in this context, keep some loans, sell some loans. And how much do I keep depends on capitalization. What about shadow banks? Shadow banks have a very distinct difference. If you see what they are doing, they are basically taking loans and selling it immediately to GSEs here, which is some investors out there. So their business model, make the loan and then sell it out the door as fast as you can. Now, the retention is there, but actually, for various reasons, which we can discuss if anybody is interested, it's biased upward. In reality, they pretty much sell everything to the investors out there. So shadow bank have a very different business model. So when you think about the spectrum of business models out there, you want to think about shadow banks doing originate to distribute on one side, and on the other extreme, you want to think about banks which have reasonable amount of capital doing both selling and keeping the loans on the books. And then you have banks with weak balance sheets somewhere in the middle, because they'll probably be doing a lot of selling, maybe a little bit of holding as well. This is going to be critical when we talk about what's going to happen in policy responses. Now, as we talk about policy, and we are going to talk about policy, we are interested in what activities, when we are going to have policy levers hit banks and shadow banks, what activities are going to move between the two entities, banks and shadow banks, why and how much. We want to quantitatively understand that as policymakers. So that requires us to understand a little bit the industrial organization. Now, industrial organization is very interesting here, because if you look at the penetration of shadow banks, I told you that shadow banks are now 2/3 of the US mortgage market. But is the penetration uniform across the segments? Turns out not really. Shadow banks are really in the part of the market which is smaller loans, which are easy to sell. Because the government is in the business of buying loans, and government is buying loans which are not very high. That's the institutional feature in the US. These loans are called conforming loans, if you're interested. Loans which are slightly larger, called jumbo loans, government doesn't buy them. And if government doesn't buy them, the only way you can originate these loans is by having a balance sheet. So banks are going to be very active in that part of this market where balance sheet is needed. And shadow banks are going to be very active in the part of the market where they can originate and sell because there's a seller in town. So that's what I'm going to sort of show you very quickly. So if you see here, what I have plotted is I showed you that shadow bank share rocketed up, but if you split different segments here, and the dotted line is the large loan segment, which has no buyers. I'll show you again. And the solid line here is the part of the segment where there is a buyer, which is the government-sponsored entity, the GSE. And what you see here, I have plotted the market share of traditional banks. Where is the decline of traditional banks? Only in the conforming market. Think about conforming market as the market where you can sell to the government. In the segment where you can't sell, banks hold steady, because you need a balance sheet, and only banks have balance sheet. If you don't believe me just with this aggregate picture, we can look at it in a more micro detail again, because we have tons and tons of data. So what does the tons and tons of data tell you? In both these pictures, on the x-axis, what I have plotted is, are you a small loan or a large loan? One is the threshold above which the government is not going to buy. Below one, government buys. Above one, government doesn't buy. All right? So in both pictures, on the left, easy to sell. On the right, not easy to sell. So what is the left picture telling you? Left picture is telling you, if you look at traditional bank market share, where is it high? Well, it's high in the segment where there is no competition or limited competition, because shadow banks cannot sell. Shadow banks have a business model of selling. If they don't have a buyer, they can't compete. Banks do pretty well. You can see that this is all driven by balance sheet, because on the right, you can see that if you see where is this loan really sitting, is it sitting on banks' books or has it been sold to some investor? What this number is telling you is that there's a dramatic more number of loans which are sitting on banks' balance sheet on the part of the segment which is harder to securitize. So that tells you that, okay, there is a element of this market where banks and shadow banks are going to compete. That's the segment where there is a buyer available. We are going to compete on price dimensions and non-price dimensions. I already told you, fintech shadow banks have a lot of non-price features that they can offer you, quickness, quality, and so on. But then there is parts of the market where shadow banks don't compete much. Banks are the only game in town. And why is that going to be important is because when we do equilibrium analysis, we got to put all of this together. We got to think about the business model, and we got to think about the industrial organization. Where is there going to be competition, and how is this competition going to be? So that's what we do in some of the work that I've done with my collaborators. And essentially, if you think about this market, and I'm illustrating it in this market because it's easier for me to talk about these things in this context, given that I've given you so much information. We think about the demand side, we model the borrowers, Borrowers derive some benefits by taking a loan. They can take a loan from either a traditional bank or a shadow bank. And in a shadow bank, you could go to a FinTech shadow bank or a non-FinTech shadow bank. FinTech shadow bank provides you higher quality, let's say. And as far as the banks are concerned, they are going to be aggressively competing where there is competition. And they're going to compete on price and non-price dimensions. And we are going to put all of this together and ask, like, if borrowers are maximizing their utility on the demand side and lenders are maximizing profits on the supply side, what does it tell you? Now, not to bore you in details, there are different elements of the model that become very important when we do counterfactual analysis, when we do policy analysis. Let me talk about two important elements. One is this feature, which is how much is regulatory burden really affecting banks? And how are we going to figure this out in the data? The other element is, what is this quality dimension that fintech banks have, which allow them to get some market share from banks? Now, the data is rich enough that we can talk about both of these things. So how do we do that? When we are talking about regulation, what we do is we compare banks with shadow banks. And we look at prices and quantity movements to back this out. And I'll tell you how we do it. When we are interested in figuring out quality dimension, we look at within shadow banks, fintech banks and non-fintech banks. Why do we do that? Because we are keeping regulation constant then. And looking at prices and quantity responses, we are able to back that out. Let me sort of put some more color into it by showing you a few pictures. So we know banks lose market share. That's a fact in the data. I've shown you that. And what I have plotted here on the x-axis is, suppose the way banks lose market share in the model was that banks' funding costs increase. That's one way in which you can lose market share. Because your funding costs go up, you have to pass it on to the borrowers, you're not competitive, shadow banks are going to come in. If that's the case, you would see that the bank market share would go down, absolutely. But then the model would say that if I look at the interest rate, that's the lower panel, interest rates should go up in the data. What you see in the data is that the shadow banks and banks, on average, charge the same interest rates. Fintechs charge slightly higher, non-fintechs charge slightly lower. On average, it's exactly the same. So this cannot be something that explains why is it that banks' share is going down, because funding costs, if they had gone up, we should have seen some interest rate response. We don't see it in the model. Here is what can explain it very nicely. On the x-axis now, what I have plotted is what happens if you put more and more regulation on banks. What does more and more regulation on banks do? It essentially leads to many of the banks retreating from the market. I showed you that in the analysis before. When the shadow banks retreat from the market, there is no interest rate response. So that's the lower panel. There is no effect on interest rates. But the market share goes down because you're leaving the market altogether. So this additional regulation that you impose on banks can explain banks' market share going down, but not really any other effects on interest rates, at least as far as the model that we have built in. So that's one element which I sort of said. Essentially what we have done is we have compared banks with shadow banks and asked the question that if your market share is going up, all else equal as a shadow bank, how is it possible that your interest rates are the same but the market share is going up? Well, it must be that the banks are facing some regulatory costs. That's what the model is sort of telling you. What about fintechs? In the case of fintechs, we compare fintech shadow banks with non-fintech shadow banks. So suppose it is the case that fintechs are gaining market share, which is the top panel. Fintechs are gaining market share. Because the fintech relative cost relative to non-fintech has been going down. That's one way in which you can gain market share, that your costs are going down. If the costs were going down, what you would find is that the fintech interest rates would go down. Okay? Market share is going up because your costs are going down, your interest rates are going down. That's not what we see in the data. I showed you already that fintechs charge a higher rate. So how can you justify this in the data through the model? Well, the only way you can justify this is that if you think about fintech quality relative to a non-fintech or to a bank on the x-axis, and now ask the question, what's going to happen? Well, if your quality is higher, you can gain market share, all else equal, and the interest rates doesn't need to go down. In fact, the interest rates can go up, and you can still gain market share is what's happening in the data. So this model boils down to sort of something that allows us to then think about counterfactuals. And like I said in the beginning, if we want to do policy analysis, we want to make sure our expected response and the actual response is not too far. And I'm going to argue that if you think about the elements of business model, industrial organization, and equilibrium, actually what you are expecting and what you see might be quite different. So let me give you a couple of examples, again, in the context of what we have sort of discussed so far. So the one policy response that we hear quite a bit about is capital regulation. So let's tighten the regulation, capital requirements on banks, or loosen it, and see what happens. The typical outcome variables that we are interested in is how much of the risk is being produced in the economy, and how much of the risk is staying on banks' balance sheet. So call it financial stability if we are only focused on banks, and how much of the aggregate lending there is in the economy. So let me show you what you can do now with the kind of analysis that I'm sort of arguing we should be doing. So here is one example. Suppose we go from capital requirements of 6% on banks to 7.5%, okay? That's what we have done in this experiment. Let's focus on the right picture first. What I have on the y-axis is the total lending volume. And then I'll have different pieces here. Remember, there is shadow banks and there are banks. And then there are two different segments here. There is the segment where you sell to the government, and there is a segment where you have to keep it on the books. So let's go slowly with this. Let's talk about the baseline first. So 6% is where we are. And the total lending volume is in the middle bar here. Here is what the bank's portfolio is going to look like at this point. And the remainder is going to be shadow banks. So the gray part is shadow banks, the rest is a bank. Now let's break this further. For a bank, if you are in the conforming space, which is the selling where you can have the option to sell to someone, you don't necessarily need to sell. You can keep it on the books as well. So let's focus on banks. What you have in blue and dark blue is an area where you can sell this loan to the government entity, but you may decide to keep it on the books. So what is the bank doing? It's selling a few loans. GSE means it's selling, and it's keeping some on the balance sheet. Okay, so that's the blue part, which is the conforming part, the part where government is active. If you look at shadow banks, the only thing they can do is sell. So of course, everything they have, they sell to GSEs. But banks also have this jumbo part, which is the part where there is no shadow bank because you need a balance sheet. And all of that jumbo loans are on the balance sheet. Now, when you tighten the capital regulation, where does the business model come in? Well, when you tighten the regulation, what's going to happen? If you look at the blue bars first, what happens is that the loans on the balance sheet contract when you move from 6% to 7.5%. Why? Because keeping the loans on balance sheet is costly now. But are the banks completely retreating from the market? No. What are they doing? They are doing the same thing that shadow banks are doing. They are also selling more now. So they continue to do the same thing that GSEs are doing. So that's something about the business model. Now, as you tighten the capital regulation, what happens to jumbo share? Not much. Jumbo market, I'm still fine because, yes, it's costly for me now to do this, but I'm the only game in town. If I'm only the only game in town, I'm profitable. I don't care that my funding costs have gone up a little bit. So that's where the industrial organization comes in. And the equilibrium is just trying to figure out what and how much quantitatively is this going to sort of matter. So we could do this exercise in this particular context when you go from 6% to 7.5%. What really happens is bank just reshuffles a lot of its lending from balance sheet to selling in the segment where an investor is available because the funding costs have gone up, so it can sell. And in the segment where it's not competing with the shadow bank, it continues to sort of make loans, keeping the loans on the balance sheet. So the aggregate effect is pretty small. When you look on the left, if you look at the aggregate effect, it's pretty small. Part of the reason is bank is just reshuffling in the middle from keeping the loans on the books to selling. And part of the reason is that shadow banks are also stepping in. Now, you can do this more generally. I showed you from 6% to 7.5%. You can go up or you can go down. So what have I plotted here? I have just plotted here, suppose you only focused on banks. If you focused on banks and asked the question, what is going to happen? Well, it's not a surprise that as you increase from 6 to 7.5%, we saw that bank was just reshuffling, so it was not really cutting lending. But as you increase the funding costs quite a bit, they are going to contract. If you're focused only on banks, you're going to say, well, lending has gone down, risk has gone down, and so on. But this is without shadow banks. Now, if you add in shadow banks are going to fill in the gap wherever banks are going to retreat, but only in the part of the market where there is a seller available. So with shadow banks, what you're going to see is that the actual response will be quite dampened. So we have affected a regulation which has hit banks, and without shadow banks, if we were looking at a response and expecting something, we would actually find that we are completely off because the actual response is much more dampened because of the presence of shadow banks. So that's a good thing. Now, is that all that always happens? Not really. Depending on the policy, you can get very different kinds of responses. Let me give you one more example. Here is a quantitative easing sort of an experiment. So what do we do here when quantitative easing happens? Let's say things become easier to sell. So the rate at which you can sell, the spread at which you can sell falls. What's that going to do? Well, that's going to affect the rate at which you can sell as a shadow bank or a bank, and that can again have different consequences depending on where we are in the distribution. So again, the baseline is what I have plotted in the middle. Suppose the cost of selling fell down by 10 basis points. What do you see? Well, shadow banks, if the cost of selling is lower, they will continue to do what they are doing, so they do that. But look at the bank. The bank is the middle part, which is the blue bar. They used to sell a little bit and keep a little bit. That's what the initial stage was. But if the funding costs relative to selling cost becomes expensive because selling is cheaper now, they'll switch entirely to selling in the middle. Jumbo side, they are going to keep pretty much the same because they are, again, the only game in town. Funding cost is fine what it is. So if you were only looking at the bank response, again, with the funding cost varying on the x-axis, what do you find? You find that as the funding cost becomes lower, banks are going to increase their volume. Why? Because they are selling as well. And if you increase the selling costs, banks are affected, but not as much because they also have a balance sheet. But now what happens if you completely ignore shadow banks? This is what you think the response is going to be. But if you include shadow banks, what's going to happen? Well, if the cost goes lower, shadow banks are going to expand a lot. If the cost goes higher, shadow banks are going to contract a lot. So when you're thinking about the aggregate response, in this case, what you're going to find is shadow banks amplify the response because it's affecting the selling market and it affects shadow banks in a big way. So the capital regulation ended up dampening the response if you ignored shadow banks. And in the case of regulation which hits the secondary market, to say, you end up amplifying the response. So let me sort of conclude with a few thoughts and implications of what I have said. So given the size of shadow banking, which I've argued has increased tremendously, I think that regulation needs to think about regulating banks and shadow banks side by side. Doing this is not just saying that, okay, shadow banks sector has grown a lot. It means trying to understand what the drivers are. Regulation and technology seem like very important factors, but when you get into each market, the contribution of each of these elements might be quite different than what I've shown you, and that's totally reasonable. But to do this regulation, we need to focus on what the business model is of shadow banks and banks, what the industrial organization is, which means how do they compete and on price and non-price dimensions, and trying to figure out what the equilibrium interaction is. Because if we don't do this, we are going to be entering into an era which looks very similar like the Lucas critique, because the expected response that we might have will be quite different than the actual response, because shadow banks and banks are now competing in a very integral way. So I showed you that this is not just a matter of saying that whenever there are shadow banks, we are missing a piece and we'll be under reporting the true response. When we talked about bank capital going up, we saw that banks are contracting, but shadow banks can fill in, so the response is dampened. When we talked about the securitization market getting costly, we said banks are not affected as much, but because shadow banks are affected a lot, there is an amplification. So depending on policy and their interaction, you see very, very different responses. And going forward, there are a few things which I didn't talk about, which are also important. Now, the bad news is this makes it more complex. But the good news is I think you can actually work through this to get more insights into how to think about intermediation. So the first thing that I would like to point out that I didn't talk much about is the risky lending that shadow banks are also doing. So shadow banks are in, I told you, in leveraged corporate loans. They are also in parts of the markets which are very, very risky, where banks have stayed away. But because you have big data, you might be confident, some might say overconfident, that you can actually go into this market. It's a low default environment right now, and you're doing a lot of risky lending. But this might have direct risk consequences, because of which we also need to think about shadow banks quite seriously. The other element that I have stayed away from is, what will traditional banks do when they are pushed quite a bit? Will they take risky gambles, or will they just continue to do whatever they are doing? And chances are they might take risky gambles as well, and that's something that's completely out of what I sort of mentioned. And the last thing, which I think is very important and something that all of you have been emphasizing, is interlinkages. What do I mean by interlinkages? There is linkage that I talked about on the real side and the product market side, but there is linkages also on the funding side. Here is the funding balance sheet of a typical shadow bank in the US mortgage market. Think about Quicken Loans. If you look at the liability side, what is the liability side? Well, 75% is coming from banks, okay? And it's coming in form of short-term debt. So what does that do? Well, if there is any problem in origination, yes, they are very efficient, it's a low interest rate environment, everything is great, but if there's any problem, the risk, the warehouse risk, is still with the bank. That's something that we didn't talk much about. And the other element is that going forward, how much of this equity is really coming from something that is liquid, the usual things that we look inside banks, or this is something that is just on paper, is something that we need to study and investigate further. So that's all I have to say, and thank you so much for the opportunity again.